Hello friends, welcome back to the channel today. Today we're going to be talking about Apple, and we're going to be doing a valuation on Apple and see where it falls in terms of its valuation. Now, before I get started, the model that I use, I've gotten several requests for it. I put it in the link to the description. It's just a Google spreadsheet, a Google sheet, and you can input values into it and it will spit out valuations for you. You can change the assumptions around, you can do whatever you want, and it will give you what you are hoping for, right? It's going to give you a valuation. So enjoy, have fun. It's how I do the models that I report on here. So without further ado, let's talk about Apple. Now, the Apple brand has benefited significantly over the years from having many fantastic products. They start out with iPods, they got iPhones, they got iPads, which at the time people laughed at, but I think people actually like them. You've got Apple Watch. Again, I kind of don't think that this was such a great hit when it first came out. People have started coming around to it as more of a fitness wellness tracker than like what they originally advertised it for. So they've got a lot of really cool products, and they sort of know how to reposition a product so that people will actually want to buy it. So that's one of the strengths that Apple has. However, what I'm seeing is that the hardware device business that they've got going on, that's a little bit slowing down, I think. I don't think that if you look at the progression of their products, you had iPods, then you had iPhones, then you had iPads, then you had Apple Watch. The thing that I'm seeing here with all of these products is that they are actually getting less and less popular over time, right? Like if you're in the Apple ecosystem, then it's really easy to pick up some of these other products. But they're more of peripherals is what they're delving into. They're not really building out any major innovative products, at least from my perspective. And I think the business is going to do well over time. But I'm just not seeing that next thing. I'm not seeing that next big product coming along. That's not to say that it's not in the works or anything like that. I just don't see anything on the horizon that's going to be as influential and as powerful as, say, the iPod or the iPhone was. Some of the things are just sort of expansions, make things thinner, add this little peripheral like a stylus, all that sort of stuff. It's not really like super duper like here's the next thing that you absolutely must own. The Apple Watch is similar to that, right? They've had to reposition it as more of a wellness thing, and that's great, and they've done well doing that. But the thing is that they're just not doing those big innovative product launches anymore. And I think the reason why they're not doing those big innovative product launches anymore is because they've become more focused on the service side of things, right? They've seen how the App Store is such a cash cow over the last, say, decade. And they've made tons and tons of money from App Store, in-app purchases, all that sort of stuff. And I think they want to get more into that space where it's they don't have to sell the physical product themselves. I mean, the App Store is a fantastic deal for Apple, right? Basically, they don't pay any of the development costs, and they get a royalty on everything that's being bought or sold in that App Store. So I think that they've seen that as a major growth driver, and they want to get more into those types of service type business segments. And so I don't think that they've been focusing as heavily on the hardware. I kind of think that's a mistake. And the reason why is because if your hardware isn't at, not to say they haven't been focusing on their hardware, they haven't been focusing on creating new types of hardware, right? Like they had new categories of hardware. They haven't been super focused on that. And I think the reason why, and I think that's going to cause some problems for them in the future. I think that it's a mistake. They own the phone market. They owned the MP3 market. They kind of sort of own the wearable market, but not like in a big way like they did with MP3s and with phones. And I think that the momentum is starting to slow there. And I think that Wall Street analysts agree with me on that. And if you don't have the super awesome hardware, then the apps and services that power that hardware and make it useful for the everyday person, that goes away. Right. And so I think it's a little bit of a misstep here. I don't think it's a major misstep. I think it's a minor one, but it's still a misstep. I think they need to, and for all I know, they are searching, right, for that next big blockbuster type product, but it's not, I haven't seen it yet, and I haven't heard any noise about what that next big thing is. Maybe it's a VR headset, something like that. But even then, I'm like, I don't know if they're actually going to like own that space in a real big way. You've got Facebook's Oculus, or I guess Meta's Oculus, that's pretty good, and they sort of have a first mover advantage. So if Apple does decide to get into the VR space, maybe. It would have to be a fantastic product, right? But if they got that working really nicely, that's great. Apple Car, I've heard that one too. I think that would be a huge mistake. I think the car industry is too competitive and too low margin for Apple. Now, could I see Apple building components for car manufacturers? I think that would probably be a better play on the auto industry for Apple, right? If Apple teamed up with Tesla, right, to build components for a Tesla, right? I think that could be very, very powerful and a very good strategic partnership, because they're both sort of the high-end brand of their categories, and teaming up together would be like, hey, look, your Tesla interacts seamlessly with all of your other Apple devices, right? Like I could see that being a real value add there. So I think manufacturing components for the auto industry might be a better play than building a full-on car outright on their own. Anyway, like I said, none of these things really seem really exciting to me. I don't see anything that the consumer would actually be like, yeah, let's do that. I want to spend money on that. I think that's the problem that Apple is sort of facing in the hardware space, because they've been super focused more on the services side. In so much that I think another small misstep that they've made is that they've gotten into the credit card game. Right? That is a very difficult game to play, a very difficult space to play. They can do it. They can do it pretty well, probably. but I think it divides the focus of the company a little bit, and it makes things a little bit harder for Apple, right? I think that going forward, what needs to happen here is what with the credit card specifically. I'm not a big fan of that for Apple. I get it. I think that the reason why they did it was because data is king. And by becoming an issuer of a credit card, they get a lot of consumer data. Like, how are people actually spending money? I think that's valuable to Apple, and that's why they did it, I think. But I think the business model side of it is going to prove to be a little bit more difficult for Apple than we think, right? But I don't think it's a pure issue credit type of a business play, right? I think that pays for the data that they're getting, right? They essentially get the data for free with the business that a credit card is. So I think that's what the Apple Card thing is about. It's about gathering your data to figure out what products, what kinds of things are people actually buying, what segments are buying those things, that sort of thing, right? So I think that's what's going on with the credit card thing. So I personally think that's a misstep because it sort of divides the culture of Apple. But when you're as big of a company as Apple, you kind of have to throw everything against the wall to see what's going to be the next growth driver. So I'm not really going to blame them for that. Okay, so that's my opinion on the company. We haven't even gotten into the valuation yet, right? So translating that into valuation space, they've historically, over the last 10 years, done about 14% growth. The analysts on Wall Street are expecting 9.5% growth. I think that the truth, given what we've talked about so far, is probably somewhere in the middle of those two ranges. So take it for what it's worth. Let's dive into the valuations using my standard model. Again, the link to that model is in the description. Like, subscribe, all that sort of stuff as well. So let's jump into the model. My standard model that I use is I look at the free cash flow per share, and I let that grow by some assumed growth rate, right? And that assumed growth rate has to do something with the things that we've been talking about thus far. Like I said, I think it's going to be somewhere between 9.5% and 14%. Where in that range, I'm not 100% sure, but I think that's probably a pretty decent guesstimate for how much Apple is going to grow over the next 10 years on an annualized basis. So my standard model is 15% required rate of return, some assumed growth rate, and then after 10 years, we're going to let it grow again for another 10 years at a 4% growth rate. Basically coming up with some sort of resale value after 10 years for the stock. Okay, so when we plug that into this model, the growth, first of all, Apple has an amazing $6.53, 54-ish cents. It doesn't divide evenly, right? Into a penny chunk, right? But anyway, they've got about $6.54 a share in free cash flow. Now, if they grow that at 14% a year, plugging that into my standard model, you get a valued price of a good purchase price for Apple at $97.61 a share. Today, it's trading for $170-ish a share, $175 a share, somewhere around that. The last time I looked, it moves, obviously, all the time. But the last time I looked, it was like in the $170, $175 range. Well, what that doesn't sound great, right? That is significantly overvalued. But again, the thing that I talk about here is, and remember, that's at the historical growth rate of 14%. That's my more optimistic end of my range for growth on Apple. So not great, right? Like it implies a price that's significantly lower value. But the thing that I want to point out is that it's not just the growth rate. You can adjust your required rate of return. You can adjust terminal values, all of that sort of stuff, right? I'm not going to touch the terminal values. I think that's a fair way to calculate terminal values. But if we start modifying the required rate of return to see what kind of a return we would get at the current price, what we get is about 8.35% a year at the current price, which, that's essentially what the market has done historically. So in terms of that, I think that Apple at today's prices are at we're sort of at a market matching rate at the 14% growth. Now, like I said, the consensus on Wall Street is actually that it's going to grow about 9.5% a year compounded annually. That makes Apple even worth less if that's true. In fact, it falls all the way down to $74.42 a share. That's a $100 gap between the current price and what I think that the valuation that I'm giving to Apple, right? Which is a very scary thing, right? It's very, very, very scary. At today's prices, that implies a 5% rate of return over the next 10 years, which is crazy low. Very, very dangerous at these prices. Now, you might turn to me and you might go, but Ryan, Warren Buffett was buying earlier this year. He was buying at $130 a share. So let's plug that in and get an implied price back out, an implied expected return back out using various assumptions. So doing that, plugging in $130 at the 9.5% growth rate, that gave Warren Buffett an expected rate of return of 8.25%, which is market matching, right? And that's at the low end of the range of my valuation, right? At the 9.5%. I think at the let's see, I didn't calculate that for the 14% growth. But what I will say is that I want to talk about what I think Warren Buffett was thinking. Now, obviously, he's a genius in terms of investing, and I'm some dude on YouTube. But I want to talk about what I think is going on here, why he was buying at $130 at getting an 8% return. One, the federal funds rate is still historic lows, right? We've been increasing it very rapidly, very, very quickly, right? Like 0.75 of a percentage point every month, right? But it's still at a historic low value, right? When I was born, it was, I think it was in the high tens. I think it was coming down off of its highs of federal funds rate of like 20% or something like that, and it was marching down from that. But I think that when I was born, the federal funds rate just broke 10% to the downside. We're still at like 2%, right? Like two, right? Very, very low, very, very depressed. So in that kind of a market, I think that Warren Buffett's like, okay, we're going to take a little bit lower of a return. The risk premium against the risk-free asset is what he's going on in his head. He's like, okay, this is actually a pretty decent return given the risk-free return that I could get by buying treasuries. So he's comparing the stocks against treasuries, and he's going, okay, 8.25, that's probably not too horrible. And he may just be doing this sort of implicitly, right? It may not be that he's actually sitting down doing these calculations, but he's been at it long enough that he probably has a pretty decent idea in his head what those calculations would turn out to be. So he probably eyeballed it and was like, oh, that's probably a pretty decent return, given the yield on treasuries at the moment. Also, the other thing that I want to say is that he's probably looking at it and going, it beats keeping the money in cash at 8.25%. And third, Berkshire's so big and has so much money that really the only place to put it is in like large cap companies, right? Like mega cap companies like Apple. And so when Apple goes to 8.25, that's a buy for him, right? It's really the only thing that moves the needle for a company as big as Berkshire Hathaway. So I think thinking through it like that, an Apple purchase at 130 for Berkshire is probably a pretty decent bet. What I will note also is that he wasn't like dumping money into Apple. He was just sort of nibbling at the edges of the market with Apple. He still has a lot of cash, like a lot of cash. So I think that what's going on here is that, he saw an opportunity to reduce his cash balance a little bit and reduce his exposure to inflation a little bit. And basically hold value, right? He wasn't really trying to like hit a home run with these Apple purchases. And I think that's what was going on there. I may be wrong, but with Apple being such a strong brand, I think he was thinking, well, inflation's high, interest rates are low. It beats holding it in cash. I'll buy a little bit of Apple while the price is a little depressed. I don't think that he would have like dumped a bunch of the balance sheet into Apple at those prices, and he didn't. I think that he would have been happy to continue nibbling. But yeah, for me, I would say that for an average investor that has a huge universe of stocks that could make a lot of money for you and move the needle quite a bit because you're not as big as a Berkshire Hathaway, Apple's probably something that you should stay away at these types of returns. But that's just my opinion. Anyway, the important thing is do good valuation work. And if you do good valuation work, you'll come out ahead. So stay rational, everybody.